Have you ever felt like the market has a mind of its own? Well, what if I told you it kind of does? That it has this hidden rhythm, a pulse that can tell you when to trade and maybe more importantly, when to just sit back. Today we're digging into an ICT concept that could completely change how you see the trading calendar.
All right, welcome to AI Explains ICT. This video is all about core content month 10, episode 15. I'd really recommend grabbing a notebook for this one because we are officially moving on to stock trading, and this stuff is key.
So let's just get right to it. The big question: does the stock market actually follow a calendar? I mean, can you predict it? Well, no, it's not a crystal ball. There are no guarantees. But what ICT shows us is that the market definitely has a rhythm. It has a predictable pulse, and it's all based on these really powerful seasonal tendencies that, believe it or not, tend to play out year after year.
Okay, so to really get a handle on this rhythm, the first thing we got to do is stop thinking about the trading year as this one long 12-month marathon. That's the wrong way to look at it. Instead, ICT breaks the year down into 3 totally distinct trading seasons. And trust me, each one has its own personality and its own set of rules.
And look, here's the proof right here. This chart shows 20 years of data for the Dow. And what do you see? This isn't just random noise, is it? You can clearly see these periods of strong, powerful moves up, and then these periods of just sideways chop. That right there is the seasonal rhythm in action. And now we're going to break it all down.
All right, let's zoom in on what might be the most critical part of the year to understand. This middle chunk from about May to October. ICT has a name for this. He calls it the low magnitude period. You can just think of it as the summer doldrums. The market gets sleepy, it's less directional, it gets stuck in ranges, it's just choppy. This is the time of year for caution, right? Not aggression. Because trying to force a big trend when it just isn't there, well, that's a really fast way to get your account chopped to pieces.
Okay, so let's put all 3 seasons together. First, you've got January to May. That's your high magnitude period. We're talking big moves, high volatility, and usually it's bullish. Then, boom, May to October hits, and the market shifts gears into that sleepy, consolidative, low-magnitude phase. And then, to finish the year off, from October to December, we get another strong, typically bullish push right into the holidays. Honestly, your number one job as a trader is to just know which of these 3 seasons you're currently in. That's step 1.
All right, so we've got the big picture, the 3 main seasons. That's the macro view. Now, let's grab our magnifying glass and zoom in. We're going to go month by month and see how these tendencies look up close. So this is the breakdown straight from ICT. It lists out the general seasonal influence for every single month. You can see he's got some marked as bullish, some as bearish, and others as consolidation. Now I know, looking at it like this as just a big list, it can feel like a lot to take in. But don't worry, we're about to make this a whole lot clearer. See? This is a much easier way to digest it all. We've just grouped the months in our 3 categories, so you can see your powerhouse bullish months right away. February, April, and then that whole final quarter of the year, October, November, December. Then the ones to be wary of, the key bearish periods, January, May, and especially that second half of September. And finally, our consolidation months, where things get messy, March, June, and August. These are the months where you should expect less of a clear trend and more of that sideways grind.
Okay, theory is one thing, right? But what does this actually look like on a price chart? That's what really matters. So let's dive into a couple of case studies and see these seasonal tendencies in the wild. Okay, first up, February. Our table called this one bullish. And, would you look at that, the chart backs it up perfectly. Over on the right, you're looking at the NASDAQ, the S&P, and the Dow. Now check out what happens early in the month. You can see what ICT calls smart money accumulation. See how the indices aren't all moving together in perfect lockstep? That's a sign. It's a hint that the market is reluctant to go lower. And what happens next? A beautiful, clean, strong move to the upside. Textbook stuff, right in line with the seasonal tendency. Now, let's flip the script. Let's look at March, which we flagged as a consolidation month. And wow, the difference is like night and day, isn't it? Just look at this price action. It's a mess. It's choppy, you've got these violent whipsaws up and down, but there's no real sustained trend anywhere. This, my friends, is exactly what a range-bound, consolidative market looks like. It doesn't mean you can't trade it, but you absolutely need a different set of tactics than you'd use in a clean, trending month like February. So, we've covered the seasons, we've covered the monthly tendencies, but what do we do with all this information? How does it actually change how we think? Well, this next part is all about making that mental shift from just reacting to whatever the market throws at you to anticipating its next likely move based purely on the time of year.
This quote from ICT really just nails it. He says, "As an investor in stocks, I still think that you need to be a trader in stocks." Now, he's not saying you have to be a day trader glued to the screen all day. What he is saying is that even if your goal is long-term growth, you can't afford to just buy and hold blindly and hope for the best. You have to be tactical. You need to know when the odds are in your favor, and just as important, you need to know when to just sit on your hands and do nothing.
And that really gets to the core difference here. Passive investing is buy and hold no matter what. You just ride the waves, good and bad. But an active approach, one that's informed by seasonality, that means you're being strategic. You're actively looking for those high probability conditions, like say being aggressive on the buy side during a seasonally bullish month, and then maybe you scale back or just trade ranges during a known consolidation month. You see the difference? You're not fighting the current. You're aligning your actions with the market's natural flow. All right, let's wrap this up. It's time to bring it all home. Understanding all this isn't just some interesting market trivia. This is about giving yourself a real, tangible, strategic edge when you approach the markets. So if there's only one thing you take away from this entire video, let it be this: trade with the seasons, not against them. Seriously, just by knowing when the market is naturally inclined to trend versus when it's likely to just chop around, you can manage your risk so much better. You can pick higher probability setups, and maybe best of all, you can avoid that gut-wrenching frustration of trying to force a trade that just isn't there during those summer months. That is your seasonal edge.
Hey, if this look at market seasonality gave you a new way to think about things, do me a favor and hit that like button and make sure you subscribe so you don't miss our next ICT breakdown. And I'm curious, is there a specific month that you always find really tricky to trade? Drop it in the comments below. A real human will take a look and get back to you. For now, safe trading.